Detroit runs on Japanese horsepower. From Toyota to Subaru, 7 Japanese automotive giants fuel the American car economy. Together, they support over 500,000 jobs and drive $170 billion in sales annually within the United States. But that powerful engine is now facing a serious threat. The White House is currently weighing the possibility of imposing a 25% tariff on imported Japanese vehicles, citing national security concerns under Section 232. If enacted, the impact won't stop at higher car prices in showrooms. It would send tremors across the entire supply chain, affecting everything from seat manufacturers in Ohio to steel mills in Alabama. As Washington considers this economic gamble, the question arises: who benefits and who suffers? This proposed tariff has escalated from policy theory to real economic uncertainty, shaking financial markets and diplomatic relations between Washington and Tokyo. Since the close of 2024, thousands of supply lines stretching from Detroit to assembly plants in Texas and rural Kentucky are at stake. Analysts, union leaders, and financial experts alike are now exploring the potential outcome. If Japanese automakers Toyota, Honda, Nissan, Subaru, Mazda, Mitsubishi, and Suzuki decide to reduce their footprint or leave the U.S. altogether, the numbers are staggering. These automakers contribute about $47 billion in added economic value and $93 billion in wages. When factoring in services, fuel, and supporting industries, the Japanese auto cluster powers a $1.3 trillion economic engine in the U.S. Their presence acts as a cornerstone in America's broader manufacturing ecosystem, linking industries from steel and logistics to software and electronics. In 2023 alone, Toyota North America produced 1.25 million vehicles across plants in Texas, Kentucky, and Mississippi. Honda followed with 970,000 cars from Alabama and Ohio. Nissan contributed 770,000 units from its Tennessee and Mississippi lines. Subaru, Mazda, Toyota, and Mitsubishi collectively added hundreds of thousands more. Despite ceasing production in 2016, Mitsubishi still supplies 75,000 rebadged units through alliances. When including imports, Japanese brands delivered 6.32 million vehicles in 2023, making up 43.6% of the U.S. passenger and light vehicle market. Looking at vehicle sales, the growth trend is clear. In 2022, Toyota Lexus sold 2.1 million vehicles. That number jumped to 2.28 million in 2023. Honda Acura rose from 1.22 million to 1.34 million. Nissan, Subaru, Mazda, Mitsubishi, and Suzuki all saw gains, driven by demand for hybrids and SUVs amid rising fuel prices and easing chip shortages. With the average vehicle price at $38,650, the total revenue from Japanese car sales in the U.S. reached $169.7 billion in 2023. From this, approximately $24.8 billion flowed into the U.S. tax system through corporate, payroll, and sales taxes. When adding costs related to energy, parts, and infrastructure, the total tax contribution rose to $31.3 billion, enough to fund years of public services in states like Ohio and Alabama. However, the looming tariff poses a direct challenge to the investment strategies Japanese firms have implemented since the 1980s, which focused on localizing production to reduce trade tensions. Many plants already use a high share of North American parts. Toyota's San Antonio line for Tundra and Sequoia is 65% domestic. Camry and RAV4 in Kentucky are at 72%. Honda's Civic in Ohio is at 68%, Nissan's Rogue in Tennessee at 58%, and Subaru's Lafayette plant stands at 52%. But critical components like transmissions and batteries are still imported from Japan or Mexico, meaning the 25% tariff would apply twice on parts and finished cars, causing a dramatic rise in costs. With already thin operating margins, Toyota at 7.1%, Honda at 5.6%, Nissan at 4.3%, and Subaru at 8.8%. These companies may be pushed into the red, especially while absorbing the rising cost of hybrid technologies. The result? Investment freezes, production cuts, or even relocation outside the U.S. could become more than boardroom hypotheticals. The labor impact of such a shift could be severe. Toyota supports 35,200 direct and 90,400 indirect jobs. Honda 28,100 direct and 61,000 indirect. Nissan 18,950 direct and 47,600 indirect. Subaru 6,900 direct and 14,800 indirect. Mazda Toyota 4,800 direct and 9,200 indirect. Mitsubishi 1,700 direct and 3,200 indirect. and Suzuki 900 direct and 400 indirect jobs. Altogether, the group supports approximately 436,000 workers, including 96,000 direct factory jobs, 227,600 indirect supply chain roles, and 113,000 induced jobs generated through consumer spending. Additionally, over 17,000 white-collar employees work in finance and leasing arms such as Toyota Financial Services and Honda Finance. This brings the total employment impact to well over 500,000 Americans. The proposed tariff may aim to protect American industry, but its consequences could undercut the very system it's trying to shield. According to the 2023 data from the Bureau of Labor Statistics, the combined salary and benefits paid to employees supported by Japanese automakers in the U.S. reaches a staggering $93.1 billion annually. These car makers have become essential to the manufacturing workforce, accounting for anywhere between 11% and 22% of total manufacturing jobs across 8 U.S. states. If Japanese manufacturers scale back or exit production due to a proposed 25% tariff, it could lead to a sharp rise in regional unemployment, up to 2.6 percentage points in states like Mississippi with limited labor capacity, and about 1.8 points in Alabama's industrial corridor. From a fiscal standpoint, the federal government is also at risk. The Congressional Budget Office projects that if the market share of Japanese automakers were cut in half within 3 years under such a tariff regime, as happened post-Plaza Accord in the early 1990s, the U.S. could lose $18 to $21 billion in tax revenues by 2026, and up to $26 to $28 billion in 2027. This estimate includes losses from port logistics, rail leases, parts warehousing, post-sale technical services, showroom rentals, and franchise operations. In total, the tax loss over 3 years could climb to between $58 billion and $62 billion. Meanwhile, the Georgia Tech Logistics Institute's multiplier model estimates that only 40% of Japanese market share losses would be offset by other brands, while companies like Tesla, Ford, Hyundai, and BMW might capture some displaced demand. The broader shock to supply chains and elevated vehicle prices would likely push half of those consumers toward used cars or simply delay their purchases altogether, shrinking the real production base. A less visible but critical concern is the potential monetary fallout. Japanese firms are key buyers of U.S. Treasury bonds and have been instrumental in keeping the yen-dollar exchange stable around 150 during periods of inflation. However, if tariffs widen the real interest rate gap, they could reduce Japanese appetite for dollar-denominated reserves. Even a modest divestment, just 5 to 6% of Japan's $1.06 trillion in 30-year Treasury holdings, could push 10-year yields up by 30 to 45 basis points, triggering a repeat of the June 2024 market turbulence known as the Davos spread. In other words, the estimated $78 billion in customs revenue expected from this tariff could be wiped out by a sudden increase in U.S. borrowing costs. Beyond numbers, there is the risk of unraveling decades of U.S.-Japan technical collaboration, lean manufacturing techniques developed by Toyota and Honda, such as just-in-time delivery, Kaizen, Anden systems, and total quality control, have been integrated into the workflow of nearly 200,000 American workers. These tools brought world-class efficiency to factories across Tennessee, Alabama, and the Midwest. Should production shift to Mexico, Canada, or Japan, many American suppliers could face deindustrialization overnight, requiring major reinvestments to meet new OEM standards from domestic or European buyers. This shift would represent not only a logistical challenge, but the erosion of 20 years of acquired manufacturing discipline, spanning from high-spec metallurgy and steel foundries to advanced cable assembly and robotics. It would also impact local training ecosystems, from vocational programs in North Alabama to research labs at Purdue University. The 0.22% annual productivity boost in U.S. manufacturing, attributed to Japanese-influenced innovation, often referred to as invisible GDP, would stall or even reverse as a result of this fragmentation. Cultural and consumer trends are also at stake. Japanese brands dominate the hybrid and subcompact SUV categories, with 60% of hybrids and 2/3 of small SUVs carrying a Japanese badge. A 25% import tax would raise hybrid prices by about $4,400, pricing out many entry-level consumers. Since many of the hybrid components, including batteries, ECUs, and CVTs, are still sourced from Japan or Southeast Asia, the cost burden is inescapable. As gas prices climb and credit becomes tighter, more Americans may opt for used vehicles or shift preferences toward diesel-powered pickups, reducing momentum for electrification. Policymakers hoping that U.S. automakers will simply fill the gap may be disappointed. GM, Ford, and Stellantis are now heavily invested in fully electric vehicles, and re-entering the hybrid or compact SUV segment would require tens of billions in new investment. Tesla, for instance, has no short-term plans to build another factory capable of producing 800,000 vehicles, and with regulatory approvals for new plants taking up to 22 months. Even replacing half of the Japanese output would be impossible before 2028. In the meantime, the shortage would cause vehicle prices to spike, consumer confidence to fall by as much as 6 to 8 points, and further complicate the Fed's already delicate soft landing strategy amid inflationary pressures. To put it simply, the 25% tariff is far more than a tax on imported cars. It's a destabilizer of the complex machinery that keeps the American auto economy humming. A withdrawal by Japanese manufacturers would create an enormous vacuum. Hundreds of thousands of jobs, tens of billions in taxes, and over $1 trillion in supply chain activity would disappear almost overnight. On paper, this might look like a win for the trade balance, but in practice it would lift bond yields, spike logistics and vehicle costs, inflate secondhand values, and drive up inflation expectations in every corner of the real economy. Most dangerously, it would replace the U.S. hard-earned, agile production ecosystem, built on decades of lean innovation, with older, less flexible manufacturing models reliant on bulk inventory and slower adjustments. If automakers like Toyota, Honda, Nissan, and Mazda begin shutting down U.S. operations due to collapsing demand, the industry won't crash immediately, but the gears will grind slower, maintenance costs will rise, and the system's overall efficiency will erode. What's your perspective on this pivotal moment? Share your views in the comments, and make sure to subscribe and turn on notifications to stay updated with our latest videos.